Hello, welcome to Velvet FinCity. In this lesson, talking about entry technique. We'll go through this tree. We'll have 2022 ICT entry, we'll have balance price range, and we'll have ST, which is known as sharp turn or turnaround. Now, the ST and the balance price range are virtually the same thing, just a little difference. Okay, let me go ahead and explain this, then I'll hop into the chart and show you examples. So look at this. Assuming we'll have a high time frame BDRA, such as an FVG mitigation block or swing high or swing low. Now price retraces or pull back to gain some momentum, to continue gain some momentum and then continue upward. Then we'll have something of this nature. Price is going to come here, then gain a little bit of strength, like reacts from this FVG, this on the lower time frame. Now form something like a swing high. Then we expect price to still come down, then clear this low, displace. So after this top hunt here, clearing this low, we want to see a displacement on the upside, taking away this this high as well. So this is intentional by the market makers to hunt those people who their stops are here and those who are here. So they are all going to be taken out of the market. Then price will come back here, retrace a little bit, and then continue on the upside. Okay, so what happened here is that we want to see a fair value gap because price is displacing. So once price displays, we want to see the formation of a fair value gap at this very point. So when price traces back into that fair value gap, then price will gain momentum to continue on the upside. But note that that is after price have displaced this high here. This high must have been displaced, then the formation of a fair value gap on this leg, then price retraces back and then continue upward. This is the 2022 entry technique or entry model. Now in the previous lesson, especially the ones I did towards the end of last year, I talked about this entry a whole lot, you understand, but presently I don't really use this entry like I used like before, because most times when price displaces towards the upside, price might not give you the opportunity to come back all the way down here. Most times price just does a little kind of retracement, and most times not even at all. Price will just continue. Yes, most time price will not come all the way back here, but this is the best, this is the most ideal. If you see it, fine, perfect. But most times you're not going to find this in the chart. So let's go through the other method that can likely happen on price action. Okay, so I think I want to remove this. Just pause and take note of it if you want to write or just look at it. Okay, so let me go through the other method, the other entry technique, which is the balanced price range. Okay, for the balanced price range, we see a situation where price comes into a PDRA such as FVG, swing high, swing low, or mitigation block, or any other PDRA. Then we see something like price trying to go up, and then it might cause a stop hunt or not cause a stop hunt. Ideally it needs to cause a stop hunt, like it needs to take away this low here, and then price comes down here, then starts going upward. So what happened here is that this is a high, this very point is a high, and then we have a fair value gap on this leg coming into this PDRA, and then we'll also have another fair value gap on this leg going out of this PDRA. Now the funny thing about this fair value gap is that they don't need to overlap like perfectly, in the sense that this one just matches with this. No, this one can be a little bit below, or this one can be up here and then a little bit above, but definitely they will have this point of intersection. They will overlap in the sense that if I should take this value gap here and then take this other one here, they will have a point of confluence where they overlap, and then they will form a kind of strong defense line where price can go up from. These are just the bullish scenarios. So that's for the balanced price range. In the example, I believe I have an example on this. Okay, now another thing I want to note is that yes, when we have the balanced price range, it's not necessary that we need to have a swing high. Sometimes you're not going to have a swing high. You're not going to have a swing high. Price is just going to form something of this nature, and then you can still have your balance price range, where you have an FVG coming in here, and then you have another FVG going out. So any of this situation can occur, but I want to see an FVG going in and an FVG going out. So that is it. Another one I would like to talk about is, assuming we have a PD array, that is the sharp turn. If I have a PD array here, what do I want to see? I just want to see something like a V or U shaped, so a complete market curve which has sellers and then buyers. So usually something like this, not exactly, no, now remember, price action don't move in straight line, you understand? So but ideally I want to see something of this nature, where there is a fair value gap when we are coming into this PD array, a fair value gap, and then another fair value gap when we are going out. Now the difference between this and the balance price range is that they don't overlap necessarily. Yes, they do not need to overlap. So the fair value gaps will not need to overlap. So this one might be here above, and this one will just be inside. Yes, or this one can still be, this can still be below here, and this one can still be above here. But ideally the best situation is when we have a fair value gap coming in and then a fair value gap going out towards the upside or just around. But from my experience, it doesn't have a challenge. Just once you just need to see a fair value gap down here and then a fair value gap here. Okay, that's another situation. Then the last one before we hop into the chart, I know this is taking time, just be patient with me. The last one is that before you take an entry, please take note of this. Before you take an entry, assuming you want to go bearish and price is going like this towards a PD array, and then you want to like finally short, like take an entry going downwards. So let's say this is a PD array, price comes into this PD array. Before you take an entry going short, please wait for the formation of a fair value gap towards your intended direction. So don't just rush and take a trade. Make sure you have fair value gaps supporting your analysis or your bias. So I want to keep seeing bearish fair value gap, and those bearish fair value gap will be overtaking some bullish fair value gap on this other side. Not just bullish fair value gap, bullish what is it called, PD arrays. You understand? So all the bullish PD arrays here, these bearish fair value gaps and bearish PD arrays should be overtaking them, like going down, showing you sign. Now, having said that, let's hop into the chart and make sense out of this. So I will use Euro USD. So let's take a look at this on Euro USD. This is a 4-hour chart. Now from the model I've been talking about DC, I'm talking about you maximizing the FVG, that is the FVG, that is fair value gaps, and we've done about 4 or 5 lessons on it already, so check out for the previous episode. So all your focus is just the FVG, and I'm not today about an entry model. Remember, our time is 1:59, so enter by 1 a.m., 5 a.m. and 9 a.m. Now another thing is that if you want to enter, take your entry and there is a news coming within that period, it can also make sense if you wait for the news. Yes, it makes sense, it's very, very important. But because I want to focus on entry technique, let me just go ahead and talk about this. So we'll have this bullish fair value gap forming towards the upside, and it makes sense because after we took away this high, it clearly shows that, or indicates that we are going towards the upside. And now ideally your target should be somewhere like here. Okay, just a moment. Another point you want to target is here. So remember, I'm doing this from the 4-hour time frame. So maybe I want to change the color of this to blue. Okay, so once price dips into this fair value gap, what's the time? This is 9 p.m. right? This is 9 p.m. not a good entry time, but I'll show you something right now. So look at how I actually mark out something. So this is the 1 a.m. candle. This is the 9 p.m. yes, and this is the one that formed the fair value gap. So now I've identified the bars for various time frames. Now remember, this is 4 hour. I'm going to, from the high of this bar to the mid of this other bar, I'm going to put a mark there using the rectangle. So that's for the blue. Okay, and then this other one, this other candle is for 9 a.m., which is I'm going to change the color, which is the ideal entry time, because most times if you do not take, if you're not careful, the candle formation can actually elude you of a whole lot of things. So let's now transpose to the 5-minute chart, a lower time frame, where we take an entry. Now if you are doing your analysis on 4-hour time frame, it's ideal you take an entry when take an entry by on 5-minute chart. If you're working with daily chart, 15 minutes 1 hour chart is okay, it's ideal. And if you're working with 4-hour chart, 5 minutes is okay, 15 minutes can also be okay, but daily chart you work with 1 hour and 15 minutes. If you're working with a weekly chart, the 4-hour is ideal. Then breaking down, the least you can go is 1 hour. If you're working with a monthly chart, daily chart is ideal. The least you can also go is the 4-hour time frame. So aligning your time frame makes it better, because the stronger an FEG is to a time frame, it makes more sense. So if I have I'm looking for stock on 4 hour and I'm seeing an FVG on 1 hour or 15 minutes, it makes a whole lot of sense, yes, supporting my bias or analysis. But ideally, just working with this time frame alignment is simple. Let's say 4 hour to 5 minutes, daily to 15 minutes, weekly to 4 hour, monthly to daily. It's just good. So let's look at this, and then thank God we're doing this together. So looking at this now, this is the point, this shaded region is the point when price came into the fair value gap, which is not our entry. We do not take any entry within this time frame. No, we take an entry rather at this point. So once price forms something like a fair value gap here, right, it's quite small to see. So we are looking for the next value gap here, which is more like this one. But then I have a whole lot of, what I say, fair value gaps here. If you can pay attention, if you can see this is a fair value gap here, one here, one here. It might not be clear to you. So most time what I just simply do is that I go up the next time frame. So this is, I'm now on 15 minutes. I'm now on 15-minute time frame. Okay. So like I said, just go one time frame ahead. Is going to be very, very helpful or useful, because if you consider going what's it called, a higher time frame, you might miss the entry, because if you can see, as you can see, we're already close to this place on this 15-minute chart, while on the 5-minute chart will be a little bit far from our target. So, and I will go back to the target and tell you why I actually marked those targets. So look at this now. Once you came into this higher time frame PD array, I want you to observe the fair value gaps that are being formed here. There's a fair value gap here, price forms a fair value gap here, not this. Okay, there's a fair value gap here, right? Now also have another fair value gap just here, another one is here, right? Okay, so this is another fair value gap. Now this fair value gaps going downward, and we are bullish according to what we say. Now if you can see, at this point we now have a bullish fair value gap going upward. And what did I tell you about this entry? This is your what? This is your balanced price range. So you see, price form another fair value gap at this, what is the time? This is exactly 1 a.m. so we're not taking any entry until it gets to 1 a.m. So by this 1 a.m. we'll have price displacing towards the upside, like an expansion bar towards the upside. Then we have another candle following immediately. So we're not going to take an entry until this candle is completely formed. Once this bar is not completely formed, no entry for us. So let's go long. If we are going long, we're entering on this candle. After it has formed, once this one open, you can take an entry. Then your stop loss is going to be where? Okay. Just right here as our stop loss. And where do we target? Already our targets are stated. So here is ideal, but we don't have much. Here is also ideal. Or you can just say 1:2. There's 1 to R. Okay, just here. Yes, perfect and fine. because we already know that price is fashioned to go upward towards the bullish. So let's go back to the 4-hour time frame. Let me tell you why. So this is an entry using the balanced price range. Now the balanced price range and the ST method are virtually the same. So what's the difference? The simple thing is that in balanced price range, we have price coming down into this higher time frame, PDRA. Price steps into it with a bearish fair value gap and then turns and goes up with a bullish fair value gap. But in balanced price range, you have a kind of overlapping. They will overlap. Yes, they will overlap. But in ST, the sharp turn, most times they will not overlap. So here we have price coming into this place and then going up, overlapping. So this is an ST entry, and we took this. So let's go to the 4-hour time frame and let me show you why. So this is me introducing a realistic and ideal target for you. Most time price can go higher than that, fine. Okay, so let me get rid of all these lines since we've actually gone through it on the lower time frame. So okay, now this expansion bar, the high is ideal for entry. I'm telling you from my practice so far, or from what I've seen, experience, price will always get to this place, or the previous candles, what is it called, the high that formed the fair value gap, because this fair value gap was formed by 1, 2, 3. These 3 candles form the fair value gap. So these are the fair value gaps. And then since we are going towards the upside, you know, definitely we are bullish. Just target 1:2 for, let's say, good equity growth and all that. So that's just it. Then I'll go through one more example on gold and then we'll be done. So still on 4-hour, but then on gold, you're not going to enter using the fair value gap. Please, for you to understand or get a full grasp of this, go check out the last video I did on CRT plus ICT concept. Okay, it looks like CRT, but I'm going to do more video on this because the process by which I trade CRT is not more like pattern trading. There is context behind it. There is enough information. So ideally, I would just call it an ICT concept because the CRT was even coined from ICT concept. But because in the community, or in this trading community, everybody knows it with CRT, that's why I just call it CRT. But if you ask me, that's not just CRT. It's based on what ICT says, because whenever I talk about CRT, you talk about a whole lot of things. So like here, we've been having a bullish price going all the way up, a bullish price going all the way up. And then remember, when you have what's it called, when you have a situation whereby price is going up, you're looking for a bearish a bullish CRT, and if price is going, you're looking for a bearish CRT. But now look at something. Just before I continue, I want you to know that nothing is 100% in trading. So let me just take you to the daily chart and even show you a trade I took and how that trade had some challenge. Okay, is it on this card? Let me go through the chart on card. I think just a moment, I need to get to the point. Okay, no, not on card, exactly on this gold. So if you check this, if those of you have seen the last video I did, now look at this. We have a CRT forming here. This is the reference candle, the high is on the daily chart, and this is the reference candle, the low. So what happened? Price weeks into here, rejects. So the next, ideally the next target is here, right? So I'm going to make more video on this particular concept. Yes, it's called CRT in the community, but the way I trade is not like the way everybody does. I trade it using ICT concept, which has to do with narrative and context. So I don't just trade it off like a pattern. Okay, so once price week rejects, we're expecting price to come to this upside, but what happens? Price quickly goes down here, engulfing towards the end side, which means more like shifting hands to the bearish end. Now this is to say that there is nothing 100% in trading, you understand? So like, why I like to talk about it is that so that you don't have an unreasonable expectation. Nothing is 100% in trading. So that you have a losing trade does not mean you are a failure. It simply means it didn't work. Simple. And we're just stacking up probabilities, in the sense that we trade high probability situation whereby we have higher chances of winning. We don't trade lower probability situation where we have lower chance of winning. And then mind you, even in a lower trading, even in a lower trading, lower probability situations, you can still have a win, just that the probability of you winning is low, the chances are just low, but that does not mean it's not possible. So I don't want you to have this belief or this mindset that, oh, everything is going to work every time. No, that is why you don't need to over leverage. You need to have sound money management. You need to be like I say, disciplined. You need to have a system and a structure. So it's not like you coming in, oh, I've seen this pattern, it must work, and then you put in everything there, and no, it's likely going to fail you. Why I say likely is simply because we are stacking probabilities here, so nothing is 100%. Even your perfect setup can't fail. So if you think it doesn't work, don't worry, go to your chart and see it. And like I will always say, I will not tell you when you're going to put in the real money here. Practice with confidence over time, or you can meet a financial advisor. A financial advisor, they can guide you on how you can go through your whole funding and all that. So you see it failed here. Now let's transpose to the 4-hour chart. And then I know this video is taking longer than I expected, and I'm so sorry about that, but we just need to do this to put things all right. So I see my setup here. Please, if you don't know how I'm actually picking or identifying this, go through the previous lesson, just the last lesson I did on CROT plus ICT concept. So we'll have the reference bar high, and then this is the reference bar low. Okay, so this is my reference bar. Then this price comes here, wicks through, rejects, showing clear indication that price wants to go down. So I want to mark out all the bars and show you how we can take an entry using this model. I'm going to still make more videos on this. I'll keep explaining this until you have something to work with. So the other method, the other entry I talk about is the one we use for our 2022 trading scheme at Fairvet, but this one is the one that can also help you if you are trading the CRT model I talked about, or the ICT market maker sell or buy model, because this is just what it is. This is ICT market maker sell or buy model, just the same thing, because it's more like a curve. That's just what it is. So having said that, I've been able to identify the 3 bars. So let's go to the 5-minute chart. So those of you who want to be trading the CRT or working with the CRT, so I'm just giving you something you can work with. Now this is clearly your market maker sell model. And now the low is your ideal target. That is your ideal target. Ideally you want to see price come to the low. So this is the reference bar, the first one, the reference bar, and then price wicks through. So on the lower time frame, you see what it's going to look like. So it's going to look completely different on the lower time frame. So now you don't have to take any entry on this second bar. You wait for the formation of the second bar to be completed. So after the second bar forms, fine, you can now take an entry. So while we are here, price comes to this third bar, right? This is a mechanical setup, so I'm not going to reference time and all that because it's more like a mechanical setup. So at this very point, watch, we'll have the formation of this fair value gap, small fair value gap. Maybe you don't trust it. Beautiful. Okay, now but after that we'll have clearly a fair value gap here. So let me draw it out. See, and this fair value gap formed after price have displaced these lows. Makes sense. Maybe you still don't take this one. Another fair value gap is here to accommodate you. Another one is here too. I think if you don't get in and then you want to use this bar to get in, this, no, it's not realistic because we've already hit the target. This is the ideal target. So let's say you take an entry from the second. So what happens is that once this fair value gap forms like this, just enter on this. After this formation of fair value gap, enter on this next bar. Don't wait for it to retrace back. If you can wait, fine, but most time it's not going to retrace back. That's the problem I have with this. Most time price will not retrace back to give you the option to enter. So just after this fair value gap forms, enter here. So we are selling from here. Then you have your stop loss should be here, fine, but ideally the swing low above the fair value gap, or the swing high above the fair value gap, or the swing low below the fair value gap is ideal, because this is a sell condition. So this is a bearish scenario. so keeping it here is fine. Or for me, I think this value gap sometimes might be scary to me, so I want to keep price here or above. But ideally, the fact that you've entered this third candle and then you have series of fair value gaps forming, going towards the downside, that tells you that price is ready or willing to go down. So I think I want to make more lessons on this, build on this CRT plus ICT concept, so that we can have something to work with as often as possible. Because if you go to NZ this week, so this is just it, and this is what's it called, this is working with the idea that says once you have fair value gaps supporting your analysis or your bias or narrative, work with it. So this is we having a bearish fair value gap and looking for a sell condition. That's why I traded off the bearish fair value gap. You understand? Okay. I want to show you something now. If you look at this NZD chart, this is NZD. Let me go to the daily or even 4-hour charts. So but before I go to this, let me go back to this 4-hour chart here. Okay, so I want to go to the 4-hour chart. Now look at this, is for today. What time is this? 5 p.m. not our entry time, so we cannot take advantage of this value gap that is forming here. No. Now look at this week. According to the model I showed you guys the previous week, we need to have an FVG form, then price think into it and go up. Now if you look at, for some time we've not had that situation. Yes, like here we had it, an FVG form, price thinks into it and continue up the up and continue towards the upside. You understand? An FVG form, continue to the upside. Now we didn't see that situation. Fine. So when we don't see it, what do? Are we going to just keep our hands and say we didn't see it? So that's why I had to introduce this CRT, so that I can see something you can work with as often as possible for those of you who have been following in the mentorship scheme. So please make sure you go see to the other lessons and participate. So having said that, I just want to show you something like the ST. Okay, look at this. There's value gap here, right? I just want to use this for explanation purpose. Value gap going up and then another one coming down. So this is an example of balanced price range as well. So going up, coming down, that's just an example of balanced price range. Okay, now look at this one where you had this value gap coming into this place, right? You have value gap and then going out, we now have another value gap. So this is similar to the balanced price in BPR, but it's not exactly the same. So we had one going and then we had one now going out, and this one makes sense because while we are going at, like, turning at this point, that's why it's called sharp turn, while we are turning around going towards this other end, you see that we have value gap here and then price have displaced all this height that has been formed here. So it's sensible or reasonable for price to start going towards the upside. So that's just what this is talking about. Thank you so much for joining. Do well to like, subscribe and comment. Like, appreciate. Thank you.